Hey everybody, my name is Dr. Winter. I'm a tax attorney and tax professor, and I am recording this in order to help you better understand how taxes apply to partnerships. So, what I'm doing in this series is I'm going to create a number of separate videos that are going to address specific issues. My hope is that it makes it easier for you to kind of jump around where you may be having problems without having to watch a 1 or 2 hour video, so you can kind of watch these shorter videos. So the first thing is we need to figure out, hey, what is it? What is a partnership? Okay, why do we even care? Now, partnerships are going to be defined as two or more people working together to earn a profit. Okay, so there's three requirements. You have to have at least two people. If you have one, you're going to be a sole proprietorship. So you need two or more people working together to earn a profit. Those are the requirements. So if you and your roommate decide you want to go somewhere for spring break or over the summer and you start selling candles, tutoring people, a lemonade stand, it doesn't matter. If you're working together to earn a profit, you formed a partnership, even if you didn't know it, even if you did not want to. Because if you look at that definition, intent is intent is not a requirement, right? We don't have intent listed on there. So by default, you will have formed a partnership if there's two or more people working together to earn a profit. What that means is that the default partnership rules will apply. So RUPA, the Revised Uniform Partnership Act, those generally will apply to your actions. Now, notice another thing. Okay, the second thing is it's not only intent isn't an element, but there's no requirement to file anything with the designated state filing agency, the Secretary of State's office in most instances. Okay, there's no filing requirement. Now, here's where things are a little bit different. When you're looking at different business structures, you have your sole proprietorship, that's for one individual, and you have your C corporation, right? I have some videos on C corporation. If you haven't seen that, you're going to want to watch those videos on C corporation. But other than that, you have a number of flow-through business entities, which means that the income flows through the business structure directly to the owners, and the entity, like our partnership in this instance, isn't having to pay taxes on those profits. So when we talk about a partnership and we say, well, you don't have to file anything, that's correct. A general partnership is the default entity for any business that has two or more people working together to earn a profit that have not filed with their Secretary of State's office. There are other types of partnerships, though. There's a limited partnership, which is called the LP, a limited liability partnership, the LLP. There's an LLC, the limited liability company. And then you also have what's known as an S corporation, and I have a whole different video that's going to deal with the S corporations for you. But all of those businesses are flow-through entities, just like the general partnership, except they went ahead and they filed with the designated state filing agency, the Secretary of State's office. And what happens is they now have limited liability protection. So if they're sued, if their partnership's going to be sued, right, in an LP or an LLP, if you're a limited partner, then what happens is all you're liable for is your investment in that entity, in the business. And if the lawsuit exceeds your investment, they can't come after, the injured party cannot come after your bank accounts, your savings accounts, your vacation homes. They can't come after any of those assets because you have what's known as a veil of protection that shields you. Now, with a general partnership, we have unlimited liability because we aren't filing anything with the Secretary of State's office. So when we're dealing with people, they can't just look us up on the Secretary of State's office and say, oh yeah, I know I'm dealing with a limited liability entity. So if you have not filed specifically with the Secretary of State's office, you will have unlimited liability. That's one of the attributes associated with it. In terms of tax, like with an LLP and those, they're going to be taxed, the same as the partnership. So these rules are going to apply to the different types of partnerships that we're talking about. But do know you do not need to file with the Secretary of State's office if you want to be a partnership. However, if you don't file with the Secretary of State's office and you're two or more people working together to earn a profit, you will be a general partnership by default. All right. Well, let's go ahead and let's start looking at the difference between our C corporation and our partnerships so we can understand what happens or what I mean by a flow-through entity, right? So like a corporation's tax at 21% and partnership doesn't have a corporate entity tax. Let's go ahead and talk about that and look at an image that kind of helps us understand that. So here's the difference between your corporate tax and your partnership tax. A corporation has to pay taxation at the business level. Okay, so as a corporation makes money, it has to pay taxes on that money. The corporation itself does. And if you recall from the previous videos, you're looking at a 21% tax rate. It's a flat tax rate for corporations. So if you made, say, $100,000 of taxable income as a corporation, then you're going to be taxed at the 21%. So you're going to pay $21,000, leaving you with $79,000 left. So we've got $79,000, and what we can do with that $79,000 is we can distribute it in the form of perhaps dividends. Now it depends on earnings and profits and some other areas that we don't need to know right now, but you distribute it commonly as a dividend. And then what happens is when your shareholder receives those dividends, they now pay taxes. But they're generally going to be paying taxes at a reduced rate if it's a qualifying dividend. So they're going to pay taxes at either 0, 15, or 20%, which is their preferred rate. And that 0, 15, or 20% is going to correlate with what their taxable income is at their individual rates, and then they get their preferred rate from there. All right, so that's a double taxation of a C corporation. So you're taxed at the entity level, 21%. Then you have the dividend, and then you have the 0, 15, or 20%. So on this image where it says corporate taxation, I should have technically put a C corporation, okay? Because S corporations are going to be taxed as a flow-through entity, kind of like the partnerships, but different. All right, so let's move over to the right of this image, and now we're looking at partnership taxation. Okay, so here's some things with the partnership tax. The business does not pay taxes. The partnership does not pay federal income taxes at the entity level. So if you had A and B partnership will not have a tax liability. Instead, what happens is the income or losses flow directly through to the partners. Okay, so you have at least two partners. It's going to flow directly through to the partners, and the partners are then going to pay taxes at their individual rates. Okay, so we don't have this 21% tax that a corporation has. Okay, so when we make money, it flows through to the individual shareholders, and what the individual shareholders are going to be taxed on is not how much money they take out of the partnership in a given year. So not based on whether they withdrew funds from the partnership that year, but on their distributive share. So how much were they entitled to? So for example, let's say that we have our partnership similar to the C corporation, but it also earns $100,000. Well, on that $100,000, the partnership's not going to pay any taxes. Instead, the people that will be paying taxes are going to be the partners, right? So let's say, for example, that the partnership goes ahead and on that $100,000, it only wants to distribute $50,000 total to its two partners, so $25,000 each. All right. Well, when we're looking at flow-through taxation for a partnership, what's going to happen is each individual partner is going to have to pay taxes on $50,000 of profit. $50,000. You might be saying, wait. You just told me that you're only going to distribute $50,000 total, $25,000 each. Yeah, that's true. But the key concept is their distributive share. If they were equal partners, they were both entitled to 50% of the profits. 50% of the profits. It doesn't matter whether those profits were retained or distributed. You pay taxes on that portion that you were entitled to, that 50% of 100,000. So yeah, you only received 25,000, but your tax is going to be based on 50,000. The reason that happens is because a partnership is not paying any entity level tax, and the code doesn't want you to go ahead and to be able to avoid taxes by simply keeping some of the money into the partnership and then distributing it at future years when your tax rate for the individual is going to be low. You see, with the corporation, they're paying 21%. And since the corporation paid 21%, the corporation can retain earnings and the shareholders aren't going to be taxed on those retained earnings. But at least the corporation, at least that tax that was retained, was taxed at the corporate level of 21%. With the partnership, it's not taxed at all. Okay, it avoided taxes on that. So it just went straight to the individual. So that's why we have to pay on our distributive share. That's an important concept to be able to get down. And we'll get through more of this in the videos as we start looking at basis, because we're going to see that your distributive share will increase your basis and withdrawals will decrease your basis. So you're still going to get a tax benefit even though you're paying taxes on the distributive share. It at least increases your basis. And then when you take a withdrawal out, withdrawals aren't going to be taxed. But we're going to get into all of that stuff in subsequent videos. Okay? So it's important right now just to know those concepts. All right, so let's go ahead and move on. So I just told you that the partnership has a flow-through entity and that you're taxed on your distributive share, and that the partnership is not paying taxes at the partnership level. So if they're not paying taxes, do they file anything with the IRS? The answer is going to actually be yes, they are. And what happens is they file the Form 1065. Now, important to note, a Form 1065 is considered an information filing. Okay, so we're not paying taxes on that Form 1065. Instead, what it's doing is it's telling the IRS, hey, here's our income and our expenses and our deductions for our partnership. So that way, the IRS has some kind of documentation of how the partnership performed, and then it can go ahead and it can look at the partners specifically and say, are the partners reporting the proper amount of income on their tax returns? Okay, so we call this an information filing that the IRS will then go ahead and use to make sure that partners are filing their appropriate amounts. So after the partnership creates a 1065, okay, giving their income and expenses and deductions, what happens is a partnership next develops or creates their Schedule K1. And the Schedule K1, it goes to all the different partners. And you can have 1,000 partners. That's fine, right? There's not a limit on that. You just have to have more than one. But there's not a ceiling on this, okay? It's going to go out to all of the different partners out there. And what the K1 does is it's going to tell each specific partner what their share of the profits or losses were, what their share of deductions were, because some deductions are going to be related specifically to a partner. Okay, so it's going to tell them about credits, their portion of credits. This is necessary because our taxpayer, our partner, cannot do their taxes until they receive the K1, right? So they have to get their K1 to see how much they should be reporting on their individual taxes. So when you're looking at the forms that should be filed with this, we're looking at a Form 1065, information filing, and the K1, which is going to tell the partners about what their tax liability is. All right, thank you for watching this first set of this first video. It kind of gives an overview of what we're dealing with partnership tax. Now what we're going to start looking at is the partnership formation. How do we form a partnership? And more specifically, we'll be looking at Section 721. And for those of you who are familiar with corporate tax already, you're going to see that 721 is a little bit similar to 351 that you dealt with corporations, except it gets rid of some things like that 80% control limit. All right, thank you for watching this video, and good luck as you continue to prepare for this for your classes and for the CPA and EA exam.